Good morning, everyone. My name is Regis Martin. I'm the chairman of the Alternative Investment Council, AIC. Thank you very much for attending this webinar. I'm proud to tell you that more than 200 people registered for today, which shows how critical the SFDR topic has become 12 months after its launch. Before telling you more about today's agenda and speakers, I would like to give you a brief overview of the Alternative Investment Council for the one who do not know us so well. So let me share my screen. So this is about the Alternative Investment Council. The Alternative Investment Council has been initiated in 2006 by its founding fund of hedge funds members who strongly believe at that time that Switzerland was missing a dedicated alternative investment association. In 2007, they joined forces with the Swiss Fund and Asset Management Association, SFAMA, and became an expert committee. Back then, SFAMA wanted to acquire more knowledge and expertise in the alternative investment field, and the AIC needed more means to pursue their goals. Today, the AIC and their members are highly recognized discussion partners with the Asset Management Association, AMAS, Switzerland, with the Swiss regulator, FINMA, the Ministry of Finance, and other Swiss authorities. The AIC consists of senior alternative investment business representative of the Asset Management Association member institutions. Its members are all on senior level and business orientated, as you can see on this slide. Our main goal is to promote alternative investments in Switzerland through conferences, events, webinars, and other publication that you may have already seen on the web. So here are a couple of things that we have done in the past years, also with IMA and with the AMAS and the publication. Coming back to the topic of today, you may ask why discussing about ESG and the SFDR within alternative investment. With my colleagues of the IAC, we started talking about that, the sustainability, ESG, SDG topic, you name it, more than 2 years ago. And despite the traction that we have seen in the meantime in traditional investments, we think that alternative investments has been struggling to catch up. In a few minutes, Dylan Eberle, legal expert at Ecofact, is going to remind us about the new SFDR disclosure requirements, which are applicable since March 2021. We'll see how challenging the next steps of the SFDR may become for the alternative investment industry. Many aspects of the SFDR are applying to all asset managers, even if they do not have focus on ESG or sustainability, or even if they are not domiciled in the EU. That's why it touches as well Switzerland. So that's later on, Aurélia Fay, sustainability expert at the Asset Management Association Switzerland, will tell us how Switzerland is positioning itself vis-à-vis this new regulation. And as you know, Switzerland has been a pioneer of hedge fund investing in the 1990s, and Switzerland is the home of many very successful alternative asset managers with worldwide footprints. That's why this topic is so critical for us in Switzerland. Coming back to our agenda, just after Aurélia Fay's presentation, will take place a great roundtable with investors and asset owners, moderated by Thomas Effliger, partner at Stepstone Group. Our three panelists, Dr. Digo Lichty, CIO and member of the executive board of Nest Pension Fund, Dr. Jörg Tobler, CIO and deputy head of the executive board at Pension Fund City of Zurich, and Mr. Pascal Frey, partner at PPC Metrics, will highlight what do investor and asset owner really need in terms of ESG and alternative investments. What do they expect from the regulator and asset manager? Because at the end of the day, of course, this should come first in regards to investments. Then, Partha Sarathi, head of asset management real estate at Pictet Alternative Advisor, Joanna Castro, head of ESG integration in private equity at Unigestion, Karin Jeselowski, head of ESG, and John Argy, co-head of alternative investment at UBP, are going to showcase how they have been dealing with the regulator filing of Article 8 and 9 SFDR funds since March 2021? And how do they intend to comply with the PAI disclosures without any certainty, well, some certainties on SFDR level 2 RTS? Please note that we will have time for questions at the end of the presentation, well, at the end of the webinar. So please be kind enough to ask them in written and in English directly in the webinar Q&A windows. The button is at the center of the Zoom menu. You can see Q&A, and then we'll hope to be able to answer to them orally or in written after that. So now I just would like to, before starting, to say a big thank you to the Asset Management Association for their great support, and namely, particularly Aurélia Fay, and of course, our speakers for their time today. So that's time to start. Thank you very much again for attending. Let's start. Dylan, the floor is yours.
Thank you so much, Régis. One moment, please. I'll share my screen. Yeah, perfect. I hope you all see it. Yeah, good morning, everyone. First of all, thank you. And it's a pleasure for me to be able to speak in front of you. And my topic today, so for 15 to 20 minutes, I'll be talking to you about the SFDR, so EU's Sustainable Finance Disclosure Regulation. And so we will basically be asking the question, what has been done so far since March 10 last year, and what needs to be done now. And so this is going to be the main topic, and here you see the agenda. First, I'll be setting the scene, and then afterwards, so I will explain how SFDR actually is applicable, or how it's relevant for non-EU entities, for example, for a Swiss asset manager. And then we ask, where do you stand in terms of product level disclosures? And then comes the question, where do you stand then in terms of entity level PAI reporting? I will use that abbreviation a lot. PAI is Principal Adverse Impacts reporting. And then finally, I have also prepared a visual timeline just to show you what's next on the implementation agenda. Okay, so let's start with the first slide, setting the scene. So here, just a few facts about the EU Sustainable Finance Disclosure Regulation. So this is an EU regulation that applies to both financial market participants and financial advisors. And it sets requirements at the entity as well as product levels. And so this third point is the specialty of the SFDR. It brings mandatory compliance, even if a financial product does not really fall under the category of a sustainable or ESG product. That means even if you have a conventional financial product, you will still need to be doing certain disclosures under the SFDR. And the fourth point, it introduces new concepts, the most prominent one being the principal adverse impacts. And we will talk about this later towards the end of my slides. And some dates here, the level 1 provisions are in effect since the 10th of March last year. And the level 2, the final rules, they will start applying on the 1st of January next year. Here I made an SFDR cake. So this, I just wanted to explain what I mean with level 1 and level 2, because I'll be using these terms often. So when I say level 1, that's the legislative act itself. So these the 20 articles that are written in the SFDR. And with level 2, I mean the regulatory technical standards, and these are the detailed rules that we will need to implement the level 1. Okay, so continuing with slide number, the next slide. So SFDR applies to the EU and non-EU entities. So this table at the first sight, it might look a bit complex, but I will summarize very briefly what it is saying actually. When you're a non-EU entity, for example, when you're a Swiss entity, the SFDR might still be applicable to you if you have an EU product at hand. So if you have an EU registered product at hand, then the SFDR is going to apply to you. But even if that's not the case, so let's imagine you have clients located in the EU, even though you don't have an EU registered product, also in that case, the SFDR would be applicable to you. So this is what this first part is showing. And the second part is basically saying when you're an EU subsidiary, the SFDR is going to apply to you in all these circumstances. Okay, and on the next slide, I will start with the product level disclosures. Here, I am showing the three main disclosures according to the SFDR. The first one is the regulatory baseline. According to this, all products must comply with Article 6 and 7 of the SFDR on a comply or explain basis. That means, so you have a product, you need to explain if it's considering sustainability risks or if it's considering principal adverse impacts. But that also means you don't have to consider these, but if that's the case, if you're not considering, you still need to make a disclosure. This is the regulatory baseline. And on top of the regulatory baseline, there are disclosures that we need to do additionally for certain products. So this second category is the disclosures for products that promote environmental or social characteristics. In practice, these are also called the Article 8 or light green products. And finally, on the third category at the bottom, we have the products that are making sustainable investments. And these are the so-called Article 9 or dark green products. Here, I dedicated a smaller portion to these products in comparison to the ones at the top, because the assumption is that these are rather a niche category, whereas it's likely that most of the products in the market are only going to be meeting the regulatory baseline. Okay. Now on the next slide, so I will continue with the product level disclosures. And we ask the question, what has been done so far? Pre-contractual disclosures, for example, the prospectuses, they have been updated to comply with the SFDR's level 1 requirements. So the existing prospectuses, they started including Article 6, Article 8, and Article 9 requirements. And in alignment with this, the product's website disclosures have also been updated. This is regulated in Article 10 of the SFDR. And these are, I just want to make sure these are level 1 requirements and they are already in force. And finally, on the third point, I have the taxonomy related disclosures. So for the first two environmental objectives, namely the climate change mitigation and adaptation, these are the disclosure requirements are already in force, and the product disclosures are supposed to begin integration of these taxonomy related disclosures into their content already since January this year. Here, on the topic of taxonomy related disclosures, I actually wanted to mention this very recent updated supervisory statement that was issued by the European supervisory authorities on exactly 5 days ago, on the 25th of March. And so the ESAs, the European supervisory authorities, there's a section where they talk about this taxonomy related disclosures, and I just wanted to mention what they're saying, because I find this is important. Firstly, they're saying regardless of the delay of the RTS, because RTS is delayed to next year. So regardless of this, the obligations in the taxonomy regulation regarding the disclosure of the proportion of investments in taxonomy-aligned activities are in force. So they're in force. That's the first thing that they said. And secondly, they actually expect explicit quantification of the extent to which investments are taxonomy aligned. So this is the second point. The expectation is explicit quantification. But thirdly, they also allow for qualitative explanation too until the application of the RTS in January next year. So this is interesting, and this can be interpreted in many ways, but these are the three points that I would make from this updated statement regarding taxonomy related disclosures. I would like to move on with my next slide. Now, what needs to be done in terms of product level disclosures? Here, I just made a list of points that that will be important to already consider now. Firstly, we start using mandatory RTS templates only beginning next year. So they become valid, they become applicable only in January next year. But we are also encouraged to start prepare ourselves and make or prepare how we would fill out these templates already now. Secondly, start calculating taxonomy alignment. As I said on my previous slide, this is already in force at the level 1 requirement. And thirdly, periodic product reports. This is regulated in Article 11 of the SFDR. And this is also already a requirement that we need to do in our periodic reports that we will issue this year. So when we are issuing an annual report between January 2022 and December 2022, Article 11 requirements need to be integrated into our periodic report. And only starting next year, we will have to use these periodic reporting templates. And the fourth point, already we should prepare for considering principal adverse impacts at the product level. This is regulated in Article 7 of the SFDR. And the deadline to do this is the 30th of December this year. And I just want to mention this PAI statement is different than what I will be talking about on my next slide. Because on my next slide, I will talk about the PAI statement at the entity level, whereas what I am mentioning here is an PAI statement at the product level. And the deadline for this is already this year, December. And the next point is make sure products marketing material matches the legal documentation. That's already written, that's already a legal requirement under Article 13 of the SFDR. And this is closely related to the avoiding allegations of any greenwashing. And finally, I really wanted to mention this point. Always remember the MiFID II definition of sustainability preferences. So you might be asking yourselves, we were talking about the SFDR, why MiFID now? The point is, we really need to have a clear idea of our products. So for example, at what percentage our products include sustainable investments, at what percentage they include taxonomy aligned sustainable investments, and whether they consider any principal adverse impacts. If so, what principal adverse impacts? So we really need to have a clear idea of our product selection so that we can offer these to the clients with sustainability preferences. So this we also have to prepare ourselves already now, because these rules, the MiFID rules will start applying in August this year. Okay, so this was up to now product related disclosures. So now I would like to talk about the entity level disclosures with a focus on PAI reporting. What is this concept exactly? So this is basically the significant negative impacts of the investment decisions and advice on certain external factors, for example, on environmental matters, on human rights, on society, on employees. This is the concept, and it's a new concept. It's different than sustainability risks, because when we say sustainability risks, there we look at the effect of external factors. So for example, effect of climate change on us, on our business, on the financial return of our products. Whereas here, the relationship is reverse. So here we are looking at the impact of our investments on external factors. And so the PAI reporting means measuring investments against predefined indicators and metrics set by the EU regulators. And where is this set? It's in the mandatory and optional indicators that you see in Annex 1 of the SFDR's RTS. And here, the aim is, it's not so easy to understand this concept, but the aim of the EU regulator is to reduce these impacts year by year gradually. So these are things, the negative things that we need to reduce. And on the right-hand side, I put some dates. The first PAI reporting at the entity level, that this is due by 30th of June next year. And the first reference period is actually already running now. So it's from the 1st of January to the 31st of December this year. And this means we need to start gathering data already now. Okay, on my next slide, I am asking the question, who must report on principal adverse impacts? The first rule, in principle, this reporting applies on a comply or explain basis, both for financial market participants and financial advisors. So this means you might be considering these impacts and disclosing on them, but you might also say, we are not considering these, but you still need to make a disclosure explaining why. So this is the meaning of this comply or explain basis. But there's an exception. So this reporting is an obligation for financial market participants that are large. So that means that have more than 500 employees, or the financial market participants that are parents of a large group with more than 500 employees on a consolidated basis. So we said this is in principle based on comply or explain, but this is an obligation for large financial market participants. And so then I ask the next question on the right-hand side, then who doesn't have to report on principal adverse impacts? Firstly, the smaller financial market participants. They can always choose to do this on a voluntary basis, but they are not obliged to do this. And secondly, financial advisors, including the large ones, they can choose to do this voluntarily. So there is not this obligation for them. And I will continue on my next slide. Then I ask the same question, then what needs to be done now? So we need to start gathering data now, because as I said, the reference period is already running since January this year. And we need to use our best effort to obtain information if this data that we need for PAI reporting is not readily available. This concept, best effort, this is taken from the RTS that was issued in February last year. But there's not really a clear explanation of what this best effort would mean. And on the third point, a reminder, I put this point because we usually receive questions mixing up the product level disclosures with entity level disclosures. The taxonomy alignment, the disclosures that we need to make regarding taxonomy alignment, this is not relevant for this entity level PAI reporting that I have been talking about. The taxonomy alignment is only relevant for the product level disclosures. And the fourth point, caution. In addition to the entity level PAI reporting, the product disclosures must also include a PAI statement. I have briefly mentioned this. This is required under Article 7 of the SFDR, and the deadline is 30th of December this year. And finally, do not postpone the compliance with RTS, because the deadline to publish the PAI reporting is the 30th of June next year. And here I have created a visual to show what's next on the agenda. This is basically a summary of dates that I have been talking about up to now, so I'm not going to mention them, each one of them. But you will have access to the slides, so you can look at them at a later stage. And this is us. So we are a consulting company based in Zurich, and we are specialized in sustainable finance and corporate responsibility issues. And if you have any questions regarding my slides or regarding this topic in general, please feel free to reach out to us. I'm happy to help. And with this is the end of my slides. I would like to hand over to Aurelia Fey from AMAS. Thank you so much.
Good morning, everyone, from my side. I hope you can see my screen. And thank you so much, Dilan. So a warm welcome to everyone. My name is Aurelia Fey, and I take care of sustainable finance within the Asset Manager Association of Switzerland. And the topic of my presentation today is really to deep dive a little bit on the Swiss approach. So of course we've discussed, and the main topic of the webinar is obviously SFDR and the EU regulation. But as Dilan mentioned, obviously the EU regulation also applies to Switzerland, and those two frameworks, the Swiss one and the European one, also evolve in parallel. And that's what I wanted to briefly show and illustrate with this presentation. First of all, it's important to reposition Switzerland asset managers and alternative investors in the broader context when it comes to sustainable finance and looking at the overall landscape. So obviously putting this together in parallel with the international framework, the EU framework, Switzerland obviously operates in that framework where political commitments have been made both at the UN and international level, but also at the European level as well, in addition to obviously the Swiss and Federal Council levels. All those political commitments translate into standards and regulations and norms that are more or less binding or voluntary, depending obviously on the jurisdiction, but also the types of standards. At the international level, there are the main standards when it comes to sustainable finance that are, not to name all of them, and this slide is not meant to be comprehensive, but are obviously the PRI and TCFD, so the Principle for Responsible Investments, that also Switzerland is highly pushing for. We've heard Dilan really brushing the entire framework in the EU and how the SFDR actually rely a lot on the EU taxonomy and how the taxonomy feeds into some of the EU disclosures, so including SFDR. And what I wanted to highlight on my side is really in Switzerland, we have a couple of regulations that starts, or at least communication from the regulator, that with FINMA basically starting looking very much closely to sustainability when it comes to approving the funds, and they've been doing that since January last year, and will continue having a much more closer focus on sustainability, as highlighted by the greenwashing guidance that has been published by FINMA in November just this year. And on the political side, important to mention that the Federal Council reiterates its ambition to tackle climate change in November 2021 with two announcements from the Secretary of International Finance as well as the Federal Office of the Environment, that basically both announced that three areas of action. The first one, making sure that basically transparency is there and is important for climate-aligned products, that there is a push in addition to decarbonization and net zero alliances, that the financial industry actually participate and take an active role in those alliances. And third, that norms and standards and definition starts basically being designed at the level of the financial industry in Switzerland. And those three main areas of action obviously have a lot of implication in the evolving ESG framework in Switzerland, and we'll discuss that in a minute. Basically, if we want to take an overall or general view of how does Switzerland compare to the EU when we look at ESG disclosure, it's important to see that there are really two different approaches at end, and that they really differ, obviously in their goals, but also all the way up to the way they are actually enforced. So obviously in Switzerland, the focus is very much on climate, while the EU is a bit more broad. Currently, we've got the environment taxonomy, but there's also an important work stream on the social aspect that will start as well. So it's broader ESG topics. In Switzerland, so we've got obviously the regulation is mostly soft and self-regulation. I'll come to that in a minute, as opposed to a hard regulation with detailed and technical standards, as Dylan mentioned, that are based on the taxonomy and that make basically the SFDR, which means that they are also mandatory and strictly enforced. In Switzerland, this regulation are mostly soft, principle-based. There are guidance. So mostly at the moment, we rely on the FINMA guidance on greenwashing and some of the circulars that are enforced by FINMA, but really relying on the market. So that, in a nutshell, looking at the two approaches. And what's important is that, in general, the approaches are different, because the philosophies behind when it comes to ESG are really, really different as well. Just as an example, and it doesn't mean it conflicts with each other. It's, again, both are intertwined, and both doesn't mean that they are opposing or conflicting. Some asset manager would actually use both, and we have to disclose both. So that's really the complexity to it. But if I just take this example, I mentioned that the Federal Council is pushing for net zero alliances with basically a focus on decarbonization. And you can see that this really opposes the SFDR, that is more global ESG, looking at taxonomy alignment, and that basically translates into a classification of products according to 3 levels that's been highlighted by Ecofact, with this Article 6 to 9, no green, light green, and dark green, as opposed to the net zero approaches, which is much more variable, and where Mark Carney likes to put it, shows 50 shades of green. So you really have much more a very different approach there as well. And that leads me to basically look at how the Swiss ESG framework is actually transforming. When we think about ESG framework and asset management in general, we like to look at the value chain. So basically look at the institute level, product level, and point of sale level. At the moment, we currently have a set of best practices published by AMAS, SSF, as well as the Swiss Banking Association. So the different associations are operating in this space. So with different set of recommendations, but currently, why is it transforming and why is it so much under kind of construction, is that we are really in the next 2 quarters working on different sets of what will become self-regulation and specific standards. At the level of the self-regulation really much covers at the level of AMAS both the institute and product level, while the self-regulation on the SBA side, obviously there is a lot of coordination and teamwork there. The SBA side focus on the point of sale. And that self-regulation, just to give you an overview, the idea is really much to have, it's a work that is ongoing, that has obviously started. The idea is to have key principles for sustainable asset management. So looking at principle for asset manager, portfolio management, marketing, promotion, and portfolio disclosures are also in scope. The idea is to have a free self-regulation, so not necessarily approved by FINMA in the first place. As I mentioned, principle-based, and really with an initial focus on greenwashing and climate. And in parallel, and what's important to keep in mind is that the idea is to have at the same time best practices and tools and really specific standards being developed at the same time that will obviously kind of feed into what are not basically principles that are not addressed at the level of the self-regulation. And that includes basically key energy data for real estate funds on one hand, ASIP framework for pension funds that are also being developed as we speak, as well as other work streams led by the State's Secretariat for International Finance, and that include, for instance, the minimum requirements for a climate score. And if I can just basically discuss that climate score initiative in a bit detail, very briefly. That initiative is currently at the stage where it's currently open for consultation. So we are taking as an association feedback from our members based on the latest proposal. And the idea of this scorecard is really to create transparency and show the extent to which financial products are actually aligned with the Paris Agreement. There are currently 6 metrics that have been defined. One of them is optional, and the idea is really to define minimum criteria to comply with each of them. So I just wanted to mention that briefly, because all this basically ESG transforming framework will start basically is currently being designed, is currently transforming, and will soon also being implemented in the next, I would say 6 to 1 year. So to echo and to basically complement what's been our topic today, obviously we've got an important SFDR, an EU regulatory framework that is again really much standards based with technical standards and requirements starting to apply. On the Swiss side, the idea is not to contradict, but to come together and take the best practices to have something that will echo or and again not conflict, but mostly align or develop in parallel to the EU regulation. And this is basically a bit of the picture as of today of the Swiss transforming ESG framework. That's for my few comments, and that's it for my presentation on the Swiss environment. And if there are no further question, I think we can start with the round table, and I will leave I will pass the mic over to Thomas Flieger from Stepstone.
Thank you, Aurelia, and good morning and welcome also from my side. It's a pleasure for me to moderate this asset owner roundtable with the 3 honorous participants, which Rémi Martin mentioned at the very beginning. And in the following discussions, we will be focusing on predominantly on the questions: what do investors really need in terms of ESG in the alternative space? And although the regulators generally is aiming actually to protect the investors from greenwashing, what actually goes beyond the existing regulation in terms of investments reporting, but also data gathering, etc. And last but not least, also, are there any differences in terms of in alternative asset classes in terms of implementing these ESG criteria? But before we plunging into discussion, I would like to briefly introduce the three panelists. And since we are addressing these questions to the investors, asset owners, it's really a pleasure to have two representatives from leading pension funds and even opinion leaders in Switzerland in this area on this panel. First of all, Dr. Jörg Tobler. Dr. Jörg Tobler, Jörg is the CIO of the pension fund of the city of Zurich, and in his function also deputy head of the executive board. Then furthermore, Dr. Diego Liechti, he's also likewise the CIO of Nest Sammelstiftung and a member of the executive board. And last and not but least, representing the consultancy industry, Pascal Frey from PPC Metrics, who advises also amongst others, small and mid-sized pension funds, amongst others, of course, in this area. In the preceding preparatory discussions of this panel, we actually identified three main topics where we would like to shed a little bit more light on. First, on the first-hand side, what are the specific needs, as already mentioned? How homogeneous are these needs within the Swiss pension fund landscape? And what does this actually mean in terms of interaction between pension fund and asset managers? The second point, in the second point, we would like to put the emphasis more on the regulatory aspects. The EU taxonomy is steering the discussion, and we would be interested in understanding to what extent is even for more and biggest pension funds, to what extent is this really relevant for the pension funds? And is there a common denominator also especially from a Swiss perspective? And last but not least, the third point, zooming more into alternative asset classes, are there any differences in terms of implementation, this ESG criteria, or are pension funds even intending to exclude certain asset classes due to this fact? Now, I would like to hand over, and I would like to start with Pascal Frey, and this is the first topic, which is the needs from the pension fund. Maybe more focusing on small to mid-sized pension fund. What are their needs? How homogeneous are they? And maybe even more important, how important is ESG for these type of pension funds?
Thank you, Thomas. Good morning, everyone. So to be clear, to answer clearly this question, I've tried to look at our clients, especially in the French part of Switzerland, and try to see how much of pension funds or institutional investors are discussing about or not discussing about ESG. And I think today, because of the size of the market with a lot of small and middle pension fund, I would say that up to 50% of the pension fund markets is not really discussing this the ESG thematics. Then you have another part, let's say between 30 and 40%. They are discussing ESG thematics. They are trying to improve their ESG portfolio, but I would say they take what they get from the asset managers, and they try to do better, but without having defined internal criteria, internal rules, and some ways to measure their improvements. And finally, and I think it's we have two representatives of this last bunch of pension funds. Around 10 to 20% of the market is big enough, is quite often also public, so with public pressure, and these funds have, or these investors have defined clearly what they want, and expect that the asset managers deliver the information they need and respect the criteria they have defined. So I would say quite quickly that that's today the market, what we see. And I will not discuss more about the asset classes. I think we will come later on this. But that's what we observe on the market. I would say, if I want to be critical, the discussion is more on the asset manager side and a little slightly less on the client side.
Thank you very much, Pascal. So for this first feedback. Now, Jörg, if I'm looking at the pension fund of City of Zurich, who has actually also dedicated resources, invested in dedicated resources in this area, your perspective might be slightly different.
Yes, indeed, for us, ESG is a hot topic for many years. We started a long time ago addressing ESG within our investment process and have developed and enlarged our approach through time. But surely the needs of smaller and big pension funds are different, but I think that at least in one respect, they are probably very much the same, namely when it comes to reporting, that it's very beneficial to asset owners if the asset management industry reports based on some standards. Because it's only if the asset managers, be that for collective vehicles or within segregated accounts, deliver information which are comparable between different asset managers or products, does it become possible for us asset owners to compare the different approaches and especially also to aggregate the numbers which the industry delivers on their products on a portfolio level, and use that information again for our own reporting. I think that's a very important issue. And I'm sitting on a committee of the ASIP, so the Pension Fund Association, and we are currently working on a reporting standard for pension funds, trying to include all types of pension funds, and we closely collaborate there with AMAS as well as with CAGAST and Swiss Sustainable Finance and CFA to have a hopefully broadly acknowledged reporting standard which enables the pension funds to receive from the industry standardized data on ESG themes.
Thank you, Jörg. I think your statement, Diego, might lead a little bit in the same direction, since Nest Sammerstiftung is one of the pension funds who is actually one of the opinion leaders actually in Switzerland, and is positioning itself as a representative of ESG criteria. So it might be, look from your perspective, also slightly different in terms of whether it's relevant or not. It seems to be quite important for you as a CEO of Nest.
In the end, yes. So Jörg mentioned more or less at least the reporting could be quite important. For us specifically, it's not that, because we want to separate all the asset management from the sustainability. So we want to have independent analysis of sustainability, and also what would be good is also independent data. So that's what we do, at least in the listed markets. And we are working on achieving that also in all other asset class, meaning the alternative space. But in the end, there, for sure, we will need the help of the reporting from the asset manager.
So my understanding is that Nest goes even beyond that, and in terms of implementation, in order also to master the process, even independently of the asset management. Maybe we will be coming back, because I think that's a very important point for the asset manager as well. We will be coming back to this point. But beforehand, I would like, I'm just interested, if we talk about needs of the pension funds, who is ultimately determining the needs? Are these the beneficiaries, or you as a representative of the pension fund? Nest, for example, how is Nest interacting with its beneficiaries? Do they ask them what is important and what not? And how does this work?
Yeah. So just to be clear, we are a Sammelstiftung. That means that firms come to us and want to work with us. So they made the decision already. So we are not like a pension fund of a corporate or from the state or something like that. And therefore, they already chosen us because we're sustainable. So that's the first thing. And the other thing, we do regularly ask our beneficiaries what they think about sustainability, what's important and what's not. And that helps us to adjust our sustainability process.
I guess, Pascal, back to you. I guess smaller and mid-sized pension funds, they have more problems actually to really have an ongoing discussion and communication with the beneficiaries in that respect, also having in mind that it's not really that important. Is that correct, Pascal?
Yes, on average, the beneficiaries, also from large companies in Switzerland, do not ask a lot about ESG investment. I have an example: 9,000 employees company in Switzerland. They got just one question about ESG investment of the pension fund. So I would say it depends on the employer. It depends on the sponsor of the pension fund. Whatever the size, if the sponsor has some philosophy concerning ESG, or do not want to invest, for example, in armaments because the company it doesn't fit with the value of the company, it's really probable that the pension fund will also invest or avoid to invest in this kind of stocks or bonds. So we cannot say the small one are not doing anything and the big one are doing a lot. It really depends on the situation of the sponsor. I see this also in very large companies. That's the sponsor who decided to go this way, and the pension fund had to implement what the employer wanted. So there are multiple possibilities, but it's clear that for the really small pension funds, what they want is to spend the least time on pension funds and just look at the return at the end and the risk of the portfolio, and that's it. But of course, if there are some pressure from ASIP or from the regulatory authorities, that would be then good, that the asset managers can work with a certain standard, a minimum standard, and I think it's what ASIP is trying to do, and that pension funds can report quite quickly and easily on these matters of ESG matters without too much additional cost and too much time.
Mm-hmm. I think one of the aspects which has already been mentioned, and that leads us to the interaction between pension funds and asset managers. On the one hand side, what I understood from Pascal, from you at the very beginning, that some of the smaller pension funds, they are just a taker of the implementation of the approaches of the asset managers. Whereas if I was listening to Diego, he was rather in the camp of, we have a dedicated separate process in ESG, and we're just looking for asset managers who can implement this. Now, Jörg, on your side, I see two principal ways actually to implement it. Rather, you have pension funds has determined its separate process, maybe back to Diego afterwards, and they are selecting asset managers who are capable actually to implement that. Or you're assessing directly or with consultants the capabilities of asset managers to integrate ESG risk. For example, what are their processes? And if you're happy with that, you delegate it more to the asset manager to implement ESG criteria in the investment process. How is the city of Zurich looking at this point?
Yeah, I'd say we do a combination of both, and it differs between our passive and active investments. With passive investments, we follow our own ESG approach. We have defined a proprietary climate strategy, for example. We have our own exclusion list, and both of these are reflected in customized indices, which are then passively followed by asset managers. And on top of this, in order to gain some impact on the real world, because this is really the goal which we try to follow within our ESG strategy, to choose ESG approaches from which we can at least hope that they impact the real world a little bit. So in order to achieve some impact on the real world, on top of our passive investments, we have a broad engagement process, both in Switzerland and abroad, with more than 600 companies. So these are our passive investments. When it comes to active investments, we take your second approach, where we rely on our asset managers. So when selecting active asset managers, we have to assess their investment process, and part of this assessment is how they address ESG risks. And our expectation is that they do that in a proper way. For example, we want that they integrate their ESG know-how within the investment team, not as a separate group which do their ESG stuff, but to really include that and integrate that in the investment process and in the investment team. Then we also expect them to engage with the investee companies, again, to use their access to the companies to push them into or towards a more sustainable behavior, and as such, again, impact the real world. And for us, of course, it's also important that our managers report on their ESG approaches and achievements, including a stewardship report is helpful to us. Yeah, so on this side, when it comes to active managers, we try to rely on their own investment process, because we choose them because being convinced that their investment process could be successful, and so we don't want to force them to change their process for us.
Now, Diego, my understanding was that you're more in the other camp, where actually Nest determines the process, etc., and where you're rather looking at the asset managers who are capable actually to implement whatever you have determined before.
Yeah. We have a totally different approach. So we really separate the sustainability from the asset management. And the reason is quite clear. So we want to have no conflicts of interest. As an asset manager, you always have a conflict of interest between performance and asset manager do then. So yeah, it's a tough question. Therefore, we separate it really. We do have our own sustainability approach. We do that with an independent consultant that analyzes the investment universe with respect our own sustainability process and gives us a sustainable investment universe. And that sustainable investment universe goes to the asset manager. And he has to pick the stocks or the bonds from that universe. So to show you the impact of that, for example, for global equities, we exclude roughly 2/3 of the benchmark due to sustainability issues. So that's quite restrictive. It's more extreme also with bonds because most government bonds are excluded. For example, we have no US Treasuries, we have no Japanese bonds, we have no UK bonds and so on. So we're quite restrictive there. And also with respect of private markets, we also have our own approach there, meaning we, unfortunately, we don't have the data for the companies there, but we do it with sectors then. We analyze the sectors and then have an exclusion list, which is much larger and dynamic for our private equity or private markets investment. So.
So thank you very much. Actually, you already raised an aspect, asset classes, which we actually have to come back again afterwards. That's a very good one. So my understanding is it might be quite ambitious also for asset managers actually to collaborate with you in order to adapt to your approaches. That's good to know. But that leads me actually to the next point, which have been actually raised already beforehand by Dylan and Aurelia. Actually, since with SFD under SFDR, the EU taxonomy has already steered actually the design of the product development. So it promotes E and S characteristics. If I'm looking at the very important points sold in the EU, only part of the investments need to be sustainable, but nevertheless, looking at you, Diego, that might be even more important, and they need to be measurable, and also to report PAI. Now, so we have actually determined, or the EU indirectly has determined 2 labels. Actually, let me call that label Article 8 or 9. So my first question is. My understanding is that, Pascal, for you or the smaller pension fund, such a label is quite helpful because it helps actually to, just black and white, to whether it's compliant, ESG compliant or not. My question would then be to you and Diego, how important is such a label at all, since you have your own view on your side? But starting with Pascal, is that a helpful approach from the EU taxonomy to determine this type of labels, Article 8, 9, for example?
Yes. I think it's an additional information for every investor, small or large, and what we see is that basically on ESG, everyone is speaking about that. Everyone is following another approach. What is ESG with one bank or is not with another asset manager. So every kind of standardization of minimum requirements is welcome. That's for sure. What we see today with clients looking for new funds, new products, is that when they get the SFDR level, the number 8 or 9, they feel more comfortable with the product. Again, then it depends on each investors. For many of them, I would say it's sufficient to say I'm 8 in this product or 9. For others, I understand it's not enough. They want more information, but I would say it helps. And it's interesting to see that since we are indirectly not under the SFDR regulation in Switzerland, it's interesting to see that more and more managers, Swiss managers, are also, for Swiss clients, publishing their SFDR number. in order to sell their product. So I don't know which standard will apply in 5 or 10 years, but at least one standard is required from the investor point of view to make the choice easier and to reduce the cost of selecting products.
Jörg, how important is that? Is such an Article 8 for you?
When selecting managers of products, that's not important to us. We look around globally for asset managers and products, and we certainly won't restrict ourselves to Article 8 or 9 products. But the information requirements by SFDR could prove useful to us as they require asset managers to provide substantial information about how they integrate ESG into their investment processes. So in order to obtain information about an asset manager, yeah, that might be useful, we'll have to see, but it won't be a requirement on our side, surely not on a product level.
Maybe just a follow-up questions regarding this point. So such a label actually requires also, the substance, which is actually data gathering from the companies, which actually indirectly is also determined by the EU regulation. And you mentioned at the very beginning, reporting is very important for you in order to aggregate, but also having the transparency. So at least this point is important for you. So there we can identify a common denominator also to smaller pension funds. Is that correct?
Yes, and I think this is maybe the biggest need for asset owners to have transparency. And if there are standards and the regulation around where you obtain such information, that's surely helpful. Absolutely.
Okay. Diego, on your side, I would assume that an Article 8 or 9 is not that relevant for you. Do I also assume that you're not pushing into a direction of a Swiss way? So it's simply you want to have your individual approach. Is that correct?
Yeah. The thing is, I can agree with what Jörg said. So I fully agree with that. So it can be helpful, but it's a nice to have, but not a need to have. And with respect to a Swiss regulation, the problem is with sustainability, it's different for everybody. Everybody has a different view on sustainability, so it's not clear. So and you always have trade-off between sustainability targets. So there's no clear cut, and therefore it will be hard to agree on one. Let's say that one definition on sustainability. So therefore, I don't see any good initiative to do so. The best thing is, and I think we all agree on that, is for sure a good reporting so that each investor can assess the sustainability of the product based on his own view. So that's the good thing. So the only thing what I could see is really an agreement. What are, let's say, the need to have on the reporting side?
Yeah. Let's maybe stay a little bit more on this topic, since I just realized that in the chat we have a question to Jörg. ESG reporting seems to be a broad subject as we identified it right now. Prioritization is due to the fact that the data sourcing is expensive, not that much advanced to some extent, as you mentioned also, Diego. Net zero seems to be most progressed. So Dave, do you have any priorities in that respect?
With respect to net zero goals?
Yes.
let me put it this way. I don't believe in formal net zero goals until 2050, because that's so far away. There can't be really substance in that. What is important is, however, and real estate might be the easiest example here, especially also for pension funds. Well, not ourselves, but many pension funds hold directly real estate in Switzerland. To have a clear strategy over the next few years, 5 to 10 years at least, what are we going to do about carbon emissions to reduce them? I think this is what is important. What are the next steps across the next few years? What is actually going on, but not any formal statements as with respect to the timeline 2050. And it's, I also would like to mention that it's these Paris-aligned benchmarks. I see a difficulty in there, also including the surveys the BAFU makes with a 2-degree initiative, whether one is on a 2-degree or 1.5-degree path with one investments. If one doesn't want to take, I call it an extreme approach as Nest, sorry for about that. But if you want to invest broadly, diversified, it's basically impossible to invest your portfolio today in a 1.5 compliant way, because the world economy as of today is not 1.5 degree compliant. And the transition to a 1.5 degree world is very important, but that will take a lot of time. And the economy will evolve gradually, and I think also the portfolios will evolve gradually. And I also would like to add here that if ESG is only how portfolios are constructed, I think this view is far too narrow. For us, engagement is at least as important, because there you can directly affect how companies behave, how what actions they take or give up. And I think this is what is really important, how the world economy works, how the companies function, and less so how portfolios are constructed.
Okay. Thank you, Jörg. In the interest of time now, I would like to maybe to move on to the last topic, and it's more asset classes. Pascal mentioned at the very beginning, Diego as well, exclusion of certain asset classes. Now let's focus on the alternatives space. Are all alternative asset classes subsumed in the same fashion under this EU taxonomy, or should we adopt different ESG approaches to specific alternative asset classes? How do you see that, Pascal?
I would like maybe first just to say one point, what was said by Mr. Tobler. What is also very important is this engagement for the equity part. I think that here almost all pension funds can act, and that's already a good step. Then and easy to implement, and I mean, it can always be complicated, but you can find an easy way to implement. Then the second step as well, before discussing about ESG criteria and reporting, the second step is when you are investing, defining your strategy, an investment strategy, is to look at the asset classes and their image, if I can say so. And clearly today, what we see is that maybe less since 2 months, but at least until end of last year, commodities, for example, were not a good ESG image as an asset class. It's polluting to extract commodities. It's speculation, investing in commodities. So many investors have stopped investing in this asset class. We could say also, then it depends on the philosophy of the investment committee, but hedge funds, it's more or less the same. It's not very transparent, very expensive. Is it really sustainable for the pension fund to invest in such asset class? On the other side, again, it's not objective, it's really a subjective feeling. On the other side, you have new alternatives like private equity, infrastructure, which have among pension funds quite a good image. It's not perfect, but at least, as Mr. Tobler says, you have engagement on one side. On the other side, we say, okay, we will commit some capital in infrastructure, maybe in green infrastructures. We are not doing perfect on the equity side or in the bond side, but at least we give a ESG touch or green touch in our portfolio with some investment in this asset class. So clearly, I see that it's not an easy one, but it's a first step to define which asset classes you will consider in your portfolio, and you can choose these asset classes with a sustainable view as well, also on the sustainable side. So clearly there are some green asset classes and there are some less green asset classes today. It can change, but today that's the fact.
Thank you. Diego, on your side, you did also mention now focusing on alternative, that you exclude certain asset classes. Could you imagine that to approach different ESG approaches to various asset classes?
So if you look at our asset allocation, we have more or less every alternative asset class in our strategy besides hedge fund. As Pascal mentioned, it will be hard to do so, and too many restrictions for them. So we have our sustainability approach also within those asset classes. So more on, let's say, on a sector level than on a company level. So on the company level, we still rely on the asset manager. So that's one thing we are trying to address in the future. So to be also independent there. So at the moment, we're excluding various industries to achieve higher sustainability. And that's not always that easy. So Pascal mentioned infrastructure. So if you take a look at that infrastructure, that's quite hard because you have no airports, for example. We don't want to invest in airports or industries like that. And most infrastructure industry sectors are not sustainable in our point of view. So in the end, you have quite, let's say, an under-diversified portfolio because you have mostly clean energy in it and some social infrastructure maybe, and that's it. And that's not really a good thing to be not good diversified within an asset class. So we, for example, we broaden up the definition a bit, and we also, for example, exclude other real assets inside of it, like, for example, timber. We have timber in our infrastructure portfolio, so that's quite special.
Perfect. Thank you very much. I think that's an elegant way also to lead over to the following presentations, which actually will be, in terms of case studies, will be focusing on various asset classes such as real estate, private equity, and very interestingly, of course, also having in mind what has been said about hedge funds now, about long-short equity funds. I think with that, I would like to stop here. my personal takeaways, which I have noting down, is, so first of all, in terms of importance, there seems to be a kind of a discrepancy between certain pension funds, whether this is an important topic or not, whether they can dedicate resources to this theme. The implementation, there are also a variety of ways to implement it, mastering the entire process and separating from the asset class as nest, but also to some extent also delegation to the asset managers until full delegation, rather for small pension funds. And then SFDR, the EU taxonomy, partially relevant to some extent. So that this Article 8 or 9 for some of the pension funds, very important, having a label. But nevertheless, the common denominator for all of the pension funds seems to be interested in information data in order to have the reportings, transparency, but also, as Jörg mentioned at the in his statement, one of his statements, also in order to be able to aggregate within the total portfolio context. So with that, I will finish here and hand over to, thank you very much. That was extremely interesting, at least for me, and yeah, looking forward then also for other bilateral discussion in this topic. I would like to hand over to Partha Sarathy from PICTE, Alternative Advisors regarding real estate investments.
Thank you, Thomas. Morning, everyone, and it's a pleasure to be here. And a warm welcome to all the participants. I would like to share our experience at PICTE launching a real estate SFDR Article 8 compliant fund. We've heard a lot about the specifics and complexities around the regulatory timings from Dylan, and also the specific requirements that we are all having to adjust towards when we launch new funds as such. And I'm specifically talking about real estate here. But I think I want to take a step back for a second and talk about why this is so important, and especially for real estate, which has been briefly mentioned before by the panelists. So I'll try to concentrate upon three main things. Number one, the why. Why is it important? Number two, as we go to launch new funds and invest into real estate asset classes, how do we approach that? So it's the how is the second piece. And then lastly, what do we need to do going forward, given where we are today with the continuously changing regulatory environment and requirements? So let me start with the why first. And I'll start with a small anecdote around 2020, when we accidentally performed one of the most epic real estate greenhouse gas emission experiments in history, where we basically stopped traveling, we stopped taking planes, we stopped taking trains, we stopped driving, we stopped consumption to a large extent. And the result of all this was that the greenhouse gas emissions around the world were reduced by 6.5%. Now, the question is that a good number or a bad number? And when you compare that against what was talked about in, for example, in the Paris Agreement, we need a 7.5% decrease of greenhouse gas emissions continuously, compoundedly across the next decade. So that kind of tells you that after having done the biggest experiment in the world to literally stop us from living our lives, we were only able to reduce greenhouse gas emissions by 6.5%, which is 1% below what we need. And that's a massive lesson learned, at least for us in real estate, because one of our hypotheses is that the reason we were not able to make a big dent is because buildings were still functioning, i.e. mostly residential buildings, which is a big asset class in itself within real estate. And we were still consuming energy from non-renewable sources, et cetera, et cetera. So let me show you a slide which kind of depicts this particular aspect in some percentages. So if you go to the next slide, I just want to concentrate on the top left corner here, where real estate as an asset class basically consumes 38% of all the energy that is produced. And roughly speaking, it produces 40% of all the carbon-related greenhouse gases. And that's across the value chain, so not just at the end building product location. Moreover, real estate consumes 55% of all the global electricity that is produced. And these two factors itself give real estate a pretty big place on the greenhouse gas emissions table, where, if we want to talk about net zero, which Jörg referred to earlier, I find it very difficult to even understand what net zero means, because technically speaking, it means you produce no carbon, period. Now, the other aspect which I want to highlight here with regards to context is Europe. And in Europe, we have 90% of the buildings, that's the bottom right chart, the pie chart, 90% of all the buildings that exist in Europe are more than 20 years old. And in fact, 85% of all the buildings that will exist in 2050 have already been built, which means that given the demographic changes that we are going to face in Europe, given the buildings that are already in place today, the biggest challenge in real estate is not about building new buildings which are net zero, as the term goes, but it's really about making sure existing buildings are repositioned, are transformed to comply with the climate requirements that we are all trying to address. And that is a huge challenge. Moving on, just to the next slide. So when we started thinking about an SFDR Article 8 fund here at Pictet, the first thing and this is back in early 2021, we started thinking, well, what does it mean to be Article 8 compliant? Because as you can imagine, even today, the regulations are somewhat being put in place, and back then they were even more loose. So I think the first thing you need to think about when it comes to real estate Article 8 SFDR funds is an approach towards compliance. And I like to use the word climate resilience as opposed to sustainability, because climate resilience is a little more actionable, at least in our case. And we are trying to, basically the first point is to understand, how do we think about climate resilience in the real estate asset class? And here's an example of our framework that we thought we should put in place for any new investment opportunity that we consider. And the framework is fairly basic in terms of thinking about energy, thinking about well-being, which is where the engagement point raised earlier comes in, thinking about building operations, and thinking about governance. And each of these pillars have sub points which relate to how you address these aspects in real estate. We've got a lot of regulations that have been already put in place to date, but the reality is, without a framework, it is very difficult to put together a new investment case, because the framework still doesn't help you dissect opportunities. So what I mean by that is, there are no comprehensive standards today, which has been again talked about in this discussion, which tell you that if you were to be an SFDR 8 or Article 8 or Article 9 fund, here's the comprehensive list of things that you should consider before you buy a building, in our case, in the real estate world. And therefore, it's very important that any investor or asset manager think about their own criteria, because the worst thing you can do is buy or invest into the wrong opportunity, which therefore becomes less compliant. And you end up in a situation where you hold a set of assets which are not able to address the regulatory requirements. So I think it's very important within our space to make sure that you have the right approach or the right way of thinking. So moving on, what that means in real terms is, if you go to the next slide, we launched a new fund called Elevation Core Plus, and which invests into real estate across Europe, in Western Europe, and predominantly looking for yielding assets, meaning there has to be some kind of an income protection or an income consistency in place at the asset level. But from a sustainability level, we had to define what that means. And that's where you see at the bottom piece of the slide, we said to ourselves, well, we want to buy buildings where we can reduce our energy consumption between 25% to 50%. So as a criteria to invest, if we're not able to get to that kind of a reduction targets, we should not be looking to invest in that opportunity. Similarly, on the next sort of pie chart, you see we're saying we want to, apologies, yeah. In the next pie chart, we're saying we want to make sure that the energy that we consume at the asset level is 100% renewable. And this goes to sort of talk about how different regions across Europe are forming their energy policies, right? I mean, in the Nordics, you see there's more prevalence of renewable energy versus other parts of Europe. And as the Ukraine crisis is unfolding, this topic has become even more important, and perhaps transformation is quicker now as we speak. And the reliance on oil and gas hopefully will decrease as we go forward. Similarly, there are other examples of metrics that we sort of told ourselves that will be part of the investment criteria with relation to water, with relation to carbon footprint, with relation to waste generation. And these are a few examples as a glimpse of the approach that we took when we thought about launching a Article 8 fund. Now, I do want to make it clear that a lot of these examples that I quoted are not fully aligned with what the regulators have said, because the regulatory requirements are still being put in place. So the key message here is that as a real estate investor today, you want to make sure that you have a sensible approach, which is comprehensive in all respects, so that as and when the regulation does come up, you're able to adjust, transform, and reallocate or recalibrate, for that matter, so that you're compliant going forward. And by going forward, we're talking about long-term funds here, which have a life of anywhere from 5 years to 20 years. So it's very critical that you're able to have an approach which is malleable, let's say. On the next slide, I'm just sort of showing the complexity of timing here. And the dark blue arrow shows you when we conceptualize, for example, that we should launch a fund which is Article 8 compliant. However, on the light blue arrow is when in the future the regulations are being put in place. And a good example here is the first reporting on PAI is actually due in June 2023. However, the reference period for that report is 2022, which means that if we were to invest in real estate today, we need to make sure that the PAI criteria are fully addressed to be reported in June 2023, which is a big challenge. And I think so far our industry has had a carrot without a stick. And what I mean by that is the carrot part is the fact that green buildings or buildings which have climate resilience trade at a premium compared to other like-for-like buildings, or command higher rental levels, which effectively means higher valuation. However, there has been no stick which tells you that you need to ensure this particular reporting methodology or this particular compliance methodology to make sure that you are classified as a green fund. And I like the phrase of 50 shades of green, and that 50 shades of green needs to disappear as we go forward, and will disappear. Just moving on to the next slide. So the question, the last section was about what do we need to do to going forward? And I think the first step here for real estate, again, is to be able to measure. And by measuring, there are a number of variables you need to measure across your asset class. And the four important ones, which are fairly basic, are energy, carbon, water, and waste. And we like to give this example quite often is that, we all live in residential units and houses. And if you were to do a survey, majority of the individuals do not know how much energy they're actually consuming. at their own residences. And unfortunately, that story is not that different when it comes to commercial leases or commercial buildings. And therefore, measuring is a very important aspect going forward, which is not done today. And it also plays into the valuation of buildings, because to date, real estate is invested without this as being a criteria. This has always been an opaque measure. Going forward, it will become very important as you invest in real estate to have measurable metrics on buildings. And I'm talking about buildings across the spectrum. So the nice and shiny buildings in central business districts across large cities in Europe, all the way to, outer city or off CBD locations within large cities. The second aspect we need to think about going forward is benchmarking them. So once you're able to figure out what is your consumption rate, we need to be able to benchmark the assets against the best performers. And by best performers, I mean assets which are able to address the climate, the Paris Agreement requirement of the 1.5 degrees Celsius. And this aspect, again, is still in development, because as you can imagine, not many properties or real estate is being measured, and therefore not much is being benchmarked. So it's sort of a chicken and egg situation right now. However, going forward, when you start thinking about SFDR and Article 8, these two aspects will become critical, and therefore, as we do more measuring, there'll be more benchmarking to be done. And lastly, the reporting. And we heard from the pension funds and the institutions investing into general partners like ours, where they need to understand what is happening at the asset level and how is the portfolio addressing the needs of the regulator. And reporting, again, will be very key. And I have emphasized that a little bit because to date, most of the business models in the the GPs of the world, or the private equity real estate investors around the world, has been so that the resources have never been allocated to these particular three aspects, resources as well as cost. And that needs to change when you think about an SFDR Article 8 fund, because you can't do any of this if you don't think about the amount of time it will take going forward, the amount of resources it will take, and the cost that it will entail. So if I were to summarize, my three takeaways from this presentation were, it is, for us as real estate investors, it is critical that we address climate change and seriously think about how to select the right investments. So selection process is critical. And to ensure that selection process, we have to have the right approach, and approach meaning the right framework to think and act. And lastly, once you figure those two things out, you need to be able to measure, benchmark, and report so that there is a governance and transparency structure in place, which effectively is able to tell market participants that you are able to make the change, and the regulator. With that, I'll stop here. Happy to answer any questions in the Q&A. And I will pass on to Joanna Castro from Unigestion, who's the head of ESG there. Thank you.
Thank you, Partha, and good morning, everyone, from my side. I'm Joanna Castro, head of ESG integration and private equity at Unigestion. I will spend the next 15 minutes to try to walk you through why we apply ESG in our private equity strategies at Unigestion. That comes with strengths, but also with some challenges, as I will come to in more detail. And I will also like to share our experience in the launching of our Article 9 fund that is actually focused on the climate. So I will also continue on the same line of climate change that Partha just mentioned. So before I start on that topic concretely, I would like to share some slides with you about Unigestion, just to give you a bit of the context on how we are really operating. on this climate fund. So I'm just trying to change the slides here. Okay, so look, just briefly on Unigestion, we are a global specialist asset manager headquartered in Geneva with 22 billion under management, mainly in private equity and equities. ESG is a key pillar of our investment DNA, and we are very proud to have 77% of our assets with ESG integration. So our ESG journey has been quite long, as you can see on this slide. We are pioneers and have really started 17 years ago with our first responsible investment equities mandate on really a very early start in our view. In private equity, in 2010, we launched a funds of funds called Ethos Environmental Sustainability. And there we have been able to back the first people that really had what today we're calling the Article 9 funds, mainly on environmental topics, as you can see. So deep diving on the ESG application on our private equity strategy. So why have we basically decided to apply ESG in our private equity strategy? So we really see a very attractive opportunity in investing in private companies that provide an important solution to the climate challenge. And as you can see on this slide, we see huge capital needs across multiple domains of our economies. And we apply ESG in this climate impact strategy because we really see it as a key pillar of value creation in any company we invest. And this will translate in attractive returns for our investors. In our view, the successful company of tomorrow will have to have high ESG standards. A good example of that, hopefully you can see on these charts. So here we are comparing ESG portfolio that we have been managing at Unigestion since 2014 with the listed index MSCI World. And clearly you can see that we are very satisfied with the strong performance that this mandate that has clear ESG criteria on its core investment thesis has been able to deliver to our investor, and it's going to be, according to our current expectations, one of the best performing portfolios we manage in private equity at Unigestion. So bearing all these considerations in mind, both on the climate attractiveness, but also on the value creation that an ESG high standards can create in delivering returns, we have decided to launch a climate impact fund that is an SFDR Article 9 fund with sustainable investment objectives that we are outlining in this page that are fully aligned with the EU taxonomy. Some of you that are more familiar with the EU taxonomy may recognize already these objectives. So out of the 6, we have selected 4 where we believe we have seen the most attractive deal flow. Climate change mitigation, climate change adaptation, protection and restoration of biodiversity and ecosystems, and transition to circular economy. Here you also have some of the subsectors that we intend to target within these big objectives of that have been defined by the EU taxonomy. So obviously, as I mentioned at the beginning, investing with an ESG focus on private equity also means strengths, but also challenges. And so if we come to that part of the challenges, obviously here we are talking about building a portfolio of sustainable investments that are in accordance with the SFDR. So here I'm just repeating a bit all what my colleagues have mentioned earlier in this session, but indeed here we are making a portfolio in each investment will have to have a positive impact on, in this case, on the climate topic, do not significantly harm assessment, and at the same time good governance. In addition to that, because we are focusing on the topics of the environmental sustainability activities, we'll also have to follow the EU taxonomy, as I alluded earlier. So while, as I mentioned to you earlier in this session, we integrate ESG across our investment process at Unigestion, this was not enough for an Article 9 fund. So we had to further enhance our investment process. And here we're just summarizing a really high level how this investment process looks like. But in the context of an article fund, it's really important that I give you a bit more details on how we have structured it at Unigestion, so we believe we would be fully compliant with the Article 9 requirements. So first, we start by sourcing opportunities that have the potential of being environmental sustainable economic activities. So at this stage, given the stage of the implementation of the EU taxonomy and where the companies are in terms of being able to provide us relevant information, we're talking about being able to find economic activities that are taxonomy eligible. Then we have a negative climate screening that excludes opportunities that would not fit our strategy very early on in the process, and particularly those that will have any type of issues that would definitely fail within our sustainability assessment. Then it comes the very important step of the process, this sustainability assessment, that it's very specific to Article 9 funds. So does the investment that you are reviewing really fit the three pillars I mentioned earlier? Positive impact, DNSH, and this is really the DNSH assessment. Can we be able to collect all the information that are at least in the 14 mandatory PI indicators we have spoken today, plus any additional ones that are relevant for the investment that we have at hand? So this is a very important assessment that comes with challenges not only on data collection, but also on benchmarking. How do you know that the gender gap of 33% is reasonable in a company that operates in the manufacturing space in Italy? How do I know that the waste recycling percentage in the US is of a company that operates in food and beverage space is actually adequate? So we really spend quite a lot of time on this assessment, not only for the issues related with data collection, which I'll come in more detail in a second, but also on the benchmarking and making sure that we do have a company that passes in our standards, the do not significantly harm assessment. Then we perform a climate impact assessment and we draft the engagement plan. Discussing earlier, going back to the early discussions that our panelists made, engagement is a topic that is obviously very important for us when talking about ESG, and here in specific, with the climate topic being at the core of our strategy, the climate impact assessment that we make allow us to then draft an engagement plan and really have a clear trajectory how we're going to make the improvement of the company during the typical 4 to 5 year ownership period that you have in private equity. Finally, but equally important, once again mentioned several times this morning, we measure and report on this climate impact. And here again, we go back to the PAI indicators that we have done and determined during the pre-investment process, but we also have other KPIs that we may have found business specific for a certain company that we will continue tracking over the life of the investment. So overall, this stringent process, as you may understand, makes us very selective on new investments and makes us very likely to reject deals that may look, for example, positive for the climate, but have probably failed the sustainability assessment or the DNSH assessment, and as a result, would, for example, qualify for an Article 8 fund, but not for these Article 9 funds. As an example, I can mention that we recently looked at a company based in the US that produces equipment that filter water or air, depending on the type of equipment. And this company manufactures equipment that then are used by several industries, namely food and beverage and pharma. And we were due diligencing the company, find it a very interesting business model, a very attractive financial profile. But when it came to collect the information that we needed to perform the do not significantly harm assessment, we really had first a struggle to get management aligned on that activity, let's say, and secondly, we really had difficulties to be able to gather the information within the time frame that was required for the transaction. So the decision was very clear for us. We had a clear conversation, very open with management, and really came to the conclusion that we weren't able to have the climate impact that we would like to have on that specific company during our ownership. So it ended up, after a significant amount of work, it ended up to being a decline opportunity for us. But we have really great comfort that throughout this process we will be able to put companies that really comply with this process. But it's a question of being very selective and also being very persistent, as you can see. At the moment, for example, we're looking at a company in the sustainable aviation fuel in Asia. That is obviously a very innovative sector that there's a lot of growth potential, but also a lot of good understanding that still needs to be built around the potential of this type of product. So there we are having very early discussions with management so that they can really understand where we are heading. We are definitely having an easier process in terms of data collection in this case, although it's a new topic for them, and that's a lot of hand-holding and education required as a result. So just to finalize on the topic, I wanted really to stress that in the private equity space, when you're talking about private companies, small in our case, for example, because we really focus on the small end of the mid-market, you definitely don't have the resources that are needed to address ESG in most of the companies. And in a lot of cases, you also face challenges that the company has other priorities, and so ESG is really on the top of the agenda. But in addition to training and a lot of handholding from the investors, I would say that the key to proceed on the ESG agenda is also the alignment with the management. From the moment that management of private companies understands that ESG will drive value creation on their company, the dynamic changes completely, and the situation really goes from a topic that it's probably more neglected to really being prioritized and being on top of the agendas of board discussions and really relevant topics. So then, if I could then walk you through now on how we really went through the Article 9 process and launched the fund. I would say that in our experience, the drafting of the prospectus, and in specific this mandatory annex that Article 8 and 9 products have to disclose as part of the prospectus, the pre-contractual disclosures, has been a quite painful process, if I may say. We had a lot of discussions, a lot of considerations to be taken when filling this template. We even had conflicting views between legal advisors and SFDR consultants on how we should answer some of the questions that are part of the pre-contractual template. And we were a bit unlucky on the timing, because after several weeks of hard work, when we thought we had a final template or annex that we could proceed with the launch of our PPM, the updated RTS came out late October, and it brought us back 3 weeks of work, because the additional level of granularity that was required made us to make significant changes. There were also a different template, new questions were added. So we came back, I would say, 2-3 weeks of work that were quite intense as well. So we were really focused on getting this pre-contractual document done. And we also look at that also in the sense that the reporting will also be easier now that we have a very clear framework around these pre-contractual disclosures. And once again, we went into quite a lot of details, so we avoid having to refile again in the future. Obviously, if there's other changes, we'll have to do it, but we try to mitigate that and put more information probably than was minimum required to avoid additional work in the future. Then when it comes really for the filing, in our case, for the private equity funds we managed that are domiciled in Luxembourg, we use a legal structure called CCAV-RAIF. And in those cases, you are not required to get each fund prospectus approved by the regulator. Instead, the regulator reviews the prospectus at the level of the AFM. So we didn't really have to go through the process that we have seen other people in the market of significant discussions with the regulator, a lot of Q&A. So really, in our experience, we had seen a shorter timeline there, that many. But overall, I think the key takeaway of this experience has been that you should try to prepare as well as possible in advance for this pre-contractual drafting if you intend to launch an Article 9 fund. Our experience with Article 8 funds has been definitely much easier, still with some challenges, but not at the same level. And the timeline that you contemplate should definitely account for this, because clearly we are all learning through the motions, and as other people mentioned today, on a framework that is constantly changing. And as I mentioned earlier, I had to go back to the drawing boards somehow when the updated RTS came out in late October. So really to give us just an high-level view on how it went for us, and moving on to the next topic that a lot of us disclosed today. For us, when it comes to PAI disclosures, very similarly to what Partha mentioned in the earlier presentation, we really see the challenges around benchmarking, but also on the measurement. And we focus on these 14 mandatory indicators that I have listed for sake of completeness on this slide, but we will also have to include any other optional ones that will be relevant for the company that we are considering. And so our focus is to collect the information required to disclose the PAIs pre-investment, because once again, in the Article 9 product, this is how you make the DNSH assessment, in addition with the EU taxonomy considerations, which for our fund in specific we'll also have to do, but PAI disclosure is definitely mandatory. And we will also do it during the life of the investment, which for us is around 4 to 5 years. And in addition to that, we also see it very important to make a comparison at the time of the exit. So how has your investment evolved since the time of the initial investment on all these KPIs? So on the measurement, as you can imagine, and alluding a bit to what I mentioned earlier to you on the ESG's challenges, a lot of comes with the issues on data collection and data accuracy. So really, can you trust the numbers that come from the company? And even before that, can you really have small private companies restricted on resources to be able to provide you this data? Some indicators are easier than others, but I tell you the amount of questions, the amount of discussions and calls that we have to have with a company to get to a satisfactory level is quite resource and time intense. Then when it comes to benchmarking, it's a matter that is equally challenging, and for the time being, given the limits of data that you have from private companies, and at some point it will definitely increase, and we can talk even in our own portfolio. But as of today, the approach we have taken is really to benchmark it versus the closest public peers. So at Ingestion, we have a large equities business, so I liaise very closely with my colleagues there. So if I look at a company that operates in healthcare in the US, I'm able to find, I have a set of peers that I use for valuation purposes and business model assessment. And I use the same type of comparables to make also a comparison on ESG metrics. And although that is not a perfect solution, and hopefully we can move for a more accurate comparison in the future, this was the best way as of today that we could find to be able to compare how the PAIs look for a specific company pre-investment, but also during the evolution of our investment life. So Today, it's really a process that we hope to improve in the years to come, but that's how we will start benchmarking the PI data that we will be able to collect. One point I would also mention is this is a company that we have in the portfolio that we're just finalizing the commitment, manufacturing energy efficiency, optical sensors that go to mechanical escalators and automated doors. And this is the type of company that I was mentioning to you that already has a clear product that has an impact, clear energy efficient measurements. They are able to give to us information on how much energy their clients are able to save by using their sensors versus a regular sensor. They are even able to tell you how much of CO2 equivalent they are saving, but they are still struggling to provide us some information on the PAIs, which are just about their own company. So just to illustrate a bit the challenges that we will continue to face in businesses in private equity that are really small. Then lastly, on the reporting, I think at Unigestion, we don't really see it as a challenge, but obviously it's a lot of time commitment. We have a standard template that we'll be disclosing PAIs on. But then we'll be working with each of the clients to understand if there are other additional requirements. As I mentioned earlier, there are several optional PAIs that we may not contemplate for all the investments. So we will be working closely with our clients, and particularly when they come to our funds to understand really what are their needs and try to tailor our reporting requirements if needed. But we will start from a standard that we will share, and then we'll take ad hoc requests on as needed basis. But definitely it will be an area that we see we will spend a lot of time and resources in the years to come. Just to conclude on my side, I would like to touch upon the potential impact of these ESG regulations in the future. And here the key question would be, should those be perceived as an opportunity or a threat? And our experience to date is really that if you are an early adopter of the regulation, like many of us have done just after 10th of March 2021, these ESG regulations can be definitely an opportunity. However, it really takes advanced preparation and really being ideally a bit of ahead of what the regulatory framework could look like. And probably 12 months is, as we are seeing now, it's probably not sufficient, but we should not underestimate the complexity and the time and resources required. So really, to be able to use it as an opportunity, being advanced and being well prepared will be core in our view. And I just thought I would share with you here a template of how the DNSH assessment of a EU taxonomy activity looks like. And this is just the beginning, and I didn't really want to bother you with the huge details on the DNSH, but we have done that for the energy efficiency optical sensors that I just alluded to earlier. So this is just to illustrate the level of complexity that it's also coming with other topics, and we know that now we have the green taxonomy, but sooner than later we'll also have a social taxonomy. So these topics will be critical, and once again will require a lot of preparation. So I would like to thank you again for your attention this morning. I hope you find it interesting, and I would like to hand over now to John and Karine for their presentation.
Thank you very much, Joanna. So it's a tough spot to be in. We're the only thing between your lunch and us, so we'll try to be quick and efficient. And I will share a few slides with you. So basically, I want to first of all thank Regis and the AMAS to welcoming us on this conference. The idea here is really to share our experience more on the traditional hedge fund. I would say in this example, in the long short equity opportunity, which is what we have experienced here. Just if we can share slides, I don't know. Here we go. So basically at UBP, what we have experienced for many years is a commitment to ESG. And I would like to introduce the fact that we have been focusing on launching long-only funds with Article 8 and Article 9 for many years. I mean, the regulation came into place a few months ago, as you all know. But really, on the governance side, we started with long-short governance fund. And that was not an Article 8 eligible fund because it was really focused on the G part of ESG and not on the environment and the sustainable part, and social part, sorry. But that one was an Article 6, and we found a strategy in long short sustainable in partnership with a hedge fund that we thought would be a good fit. And so it required a lot of work, and we can go into more details over the next few slides. So really just to present the business of the EU Access Ireland, which is our UCITS platform in Ireland. We basically partner with hedge fund manager. So there are two levels of commitment to ESG. It's really the UBP level, of course. But more importantly, we need to find a partner that will be the portfolio manager of this fund that has a true commitment to sustainable investing. So it required a lot of work. Previously I heard that some of you were working with consultants. That was the case for us, and it was not very clear where the regulation was going, and especially for a long short fund, and we'll address a few points later. But really, what's interesting here is that we have been doing this business for more than 8-9 years, and really now we're only focusing on ESG and sustainable. And like everything, the long-only world and the traditional world led the way. And I think what's interesting today is to see all these alternative players that are trying to catch up. And so that's something that we have focused on. If we look what we have done at the UBP level, and I'll transition that to Karine, but at the UBP level, there has been a clear commitment. And I will let Karine go into there in more details, but really at the hedge fund level and at the investment level, we have seen an increased demand from the client side. Clearly, we have discussed in different panels today that there is a need for ESG investments, but also as asset manager or hedge fund managers have been focusing on that and and focus their investment into that space. And what we were missing is a lot of data, and we still see some asset classes where data is missing. But in equities, we have seen a lot of work done by service providers to provide measurable outcomes, and I think this is really a key point. And if you will, that's a level which is for all asset managers here to apply pressure on corporates to see change. So on that note, I think I'll keep it short and will hand over the mic to Karine.
Yes, hello everyone. Indeed, so maybe just on this, I just want to come back on the fact that in terms of UBP responsible investment, we have a responsible investment policy, and we believe that to some extent it's applicable across asset classes. So the question is how, and I think that's the main point we want to discuss here, is how do you make sure that you can have a long-short strategy that would indeed be classified as Article 8 or be compatible with an Article 8 according to SFDR. And the key point for us, as was just mentioned by John, basically we're working with external managers. And we first have to be pragmatic with the regulation, but also understand the external manager and what they do. So when it comes to SFDR, it was mentioned, I think, several times before, it's little prescriptive. Nothing tells you what are the minimum criteria to be an Article 8, what are the minimum criteria to be an Article 9. Article 9, to some extent, is better defined because we are looking at sustainable investment. There is a definition of what a sustainable investment is. So to some extent, that's okay. But Article 8, you really see that there is a big mix of type of Article 8 strategies. So the first thing is, how do you fit that? And it's even less prescriptive when it comes to alternative strategies or long-short strategies. Nothing tells you you can't do it. So definitely it's open. Alternative funds are, in scope for SFDR, but nothing tells you what to do with the long versus the short book. How do you address that? So our approach was really to be pragmatic and really focus on the intent of the investment strategy. What is the investment manager trying to do? Are they going to apply ESG to the long and short trades? Does it make sense to apply it on the long and short trades? So this was really the first discussions we had. So first, just a quick step back, we're talking external managers. So the first thing is making sure that you have in-depth ESG due diligence on the product and on the manager. And then you have to make sure that their investment approach or responsible investment approach is to some extent aligned with yours. It was also mentioned by one of the panelists that sustainability can be understood differently by anyone. So at least making sure that you have a similar philosophy and similar approach makes sense. And also you want to make sure, for us as the investment or the manager of the EU access strategy, we want to make sure that we set minimum requirements that works for us in terms of what should be minimum approach to an Article 8, but also that again it fits with the manager. And that's where the discussion takes place. And I have to say, I was told, I'm being head of ESG, I was of course involved in the discussion, and I was told ex post that potentially we took a little bit too much time to reach the filing of this prospectus. But I think now we recognize that it makes sense. So we learned from the first strategies we had offered as Article 8 or proposed as Article 8, which were all long-only strategies. So we learned from that on the filing process and what was required by the regulation. But also we had to make sure that this was well understood by the investment manager, which happened to be non-EU based. So understanding the regulation, having an ESG strategy is one thing. Understanding what it means in the context of SFDR, in the context of an Article 8 fund, that's really where the challenge was. So one of the points we were asked to address is, what about, how will you go about SFDR Level 2? And I think one thing that I made very clear when I started discussing, I think it was early in the second half of last year. So with the manager, it was already to go through the Level 2 requirements. I think if you forget about of course now we are very close to this Level 2, but at the time, I was told, well, let's focus to Level 1 and we'll see. But it's actually very important to understand what are the Level 2 requirements. It's all good to say I promote environmental strategy or social characteristics, but actually Level 2 asks you, what is it you do? What is this environmental or social characteristic that you actually claim to promote, and how do you do it? It's also about, are you going to have sustainable investment or not sustainable investment? So we really went through all those points one by one with the external manager to make sure that, first of all, they understood that this would be the end game, because to some extent there has been a little bit of confusion to start with about, well, let's stick to Level 1 and we will have some Article 8 fund Level 2 and some Article 8 fund Level 1. No, everyone goes to Level 2, so you need to make sure you can do it. So all those discussions, at the end of the day, what we tried to address was really looking at what the the portfolio manager was doing. We've set up a minimum exclusion list addressing, for instance, the need to exclude breaches of UN Global Compact, or reducing, limiting exposure to coal, all these kind of things we went through with the manager, and then really looking at their philosophy, and maybe we can see this is what we see here. Really is what the manager is doing is really looking at, I would say, three aspects, two important, two key ones in terms of addressing environmental and social characteristics. One is around climate and the other one is diversity. And this is really going through the whole process of selecting on the long book. So our exclusion list is about, all the investment universe, long and short, but in terms of the investment philosophy and how we address and how do we try to have positive outcomes, it's really on the long book, because this is what we own, and this is where we can actually engage with companies about the fact that they should improve. So we've set up a series we discussed, and that part of their philosophy, that was already what they were looking at. So we've addressed, of course, on the climate side, looking at energy efficiency, addressing the fact whether or not companies have science-based targets. On the diversity side, it's really diversity on the board, but also across the company through the EEO, which is this kind of report, US report about equal employment opportunities. So all this is addressed. And the last point we had on the previous slide is about transparency. So there's a willingness to engage with companies in case there is a lack of transparency. And I think this is really some of the points that will be addressed directly with the companies through the engagement. So this is really important, and making sure that the companies we have on the long books are transparent about what they do, and if anything, focusing on this when it comes to potentially engagement. But this is really what we're trying to do. So at the end of the day, what we've, being pragmatic is about, what is in the strategy, what is required by the regulation, which is limited in terms of their approach. So what we know is we're looking at the long book, we're looking at carbon emissions, and that's what you're looking at on the next slide. We're targeting to have very, reduced carbon emissions compared to what is the investment universe of this type of strategy, which is MSCI World, of course. So this is really what we will have as measurable. We made sure to have that, of course, on their side and on our side, we have tools to measure, to control. That's very important. We have the risk assessment and risk control on our side to make sure there are no breaches, using the same data providers and so on. So you need to tick all those boxes basically to be in line with, being comfortable that your strategy will be, we hold to what it says it does. We've addressed, so principal adverse impact is one of the aspects. So for these strategies, we did not go into, as the first draft of the prospectus, we didn't, mention the PAIs we would consider for this strategy as level 1. We're not obliged to do it, and we wanted to have additional discussions with the manager, but the strategy per se is very clear. So of course, some of the GSG PAI in the next version of the prospectus, we will mention, of course, this GSG PAI and diversity and, of course, controversial weapons, which is a standard for us, and UN Global Compact, making sure that the companies we have in the portfolio do not breach UN Global Compact or do not breach the OECD guidelines for multinational enterprises. So we have already discussed this with the manager. We are all comfortable with those, and this is what we will file for the next version of the prospectus ahead of the end of this year, of course, as level 2. no sustainable investment, no EU taxonomy for such a strategy. It's not in line with the ESG philosophy and the approach of the manager, which again is something that we need to align. So there is also some push for having sustainable investment everywhere potentially and so on. But actually, you need to make sure that the manager is comfortable with the requirements. So for now, this strategy will focus on, of course, the environmental and social characteristics to be addressed, and on the PAI consideration. Just one thing, because one of the questions we were asked also to address is about the filing process with the regulator. I have to say, because we had, well, I guess it helped. We had already done this Article 8, at least long only. So we had already filed some products. We knew potentially we had some feedback at the time from the regulators, potentially on some mention that needed to be in the prospectus. And I have to say the filing of this one was pretty smooth. So we filed, as mentioned earlier, with the Irish regulator. But because we had addressed all the points ex ante, it actually went quite well. So we didn't have much of an issue there. I think that's it for me for the key messages we wanted to address. John, do you want to do you have anything else to add?
Yeah, so I think, thank you very much, Karine, for this presentation. I think that this is a trend in the industry, and the alternative industry, especially on the hedge fund side. This will be we'll see more managers, more platforms, more peers, going into Article 8. Article 9, let's see, I haven't seen yet, but Article 8 fund for sure. And yeah, we're excited for what's next. So maybe Régis, should I hand it over to you?
Thank you so much, Karine and John. You have been the last one, and hopefully there are still a lot of people tuned in. We will have of course the number of attendees in a short time. So we will see if you have been able to keep them motivated until the end, which was quite a challenge. Thank you very much to all speakers. Thank you very much to AMAS for this great webinar. I'm so sorry for attendees that we have been so long. However, it was very important for everyone to say what they had to say. This webinar will be able to you will be able to listen to it and to see it because it has been recorded on the AMAS website. And at the end of the day, thank you very much to everyone again, and I hope to see you next time for another SFDR or ESG seminar provided by the AMAS and the AIC. Thank you so much, and enjoy your meal.